We might be about to see a flood of money printing hit the markets over the next couple of months, as we have a ton of changes to both monetary policy and fiscal policy coming down the pipeline. And I'm going to show you every single one. And then we'll talk about how that might impact both markets and the economy as all of that easing makes its way through the financial system and what that means for you. So first up, we have changes to the Federal Reserve's balance sheet. You can see that their balance sheet has been declining for the last couple of years. And at their last meeting, they announced that this will be coming to an end. In other words, this flat line on their balance sheet that you saw from 2015 through 2017, where their balance sheet didn't change, is what the Fed is saying is going to happen from here. Now, on the surface, that might look like there's no quantitative easing and there's no quantitative tightening, which means there should be no net impact on the overall economy. And technically, that's true. But at the same time, as they end quantitative tightening, they'll also be engaging in what is basically their own version of an operation twist, where they change what they hold on their balance sheet under the label of normalization. Yes, the Fed is always doing short-term plumbing behind the scenes, but here we're talking about the slower balance sheet moves that shape financial conditions over months, not just overnight. And when they shift the composition of trillions in assets, it changes which parts of the economy feel tight and which parts feel loose. So the first step in this process is obviously ending the quantitative tightening. That will have somewhat of an easing effect on the market because they're no longer withdrawing liquidity from the financial system. But starting December 1st, they will continue to bleed mortgage-backed securities off their balance sheet, and they'll take that money and roll it over into buying T-bills. So while this will continue to drain money out of the mortgage-backed securities market, it will replace that liquidity into T-bills, which are used for fiscal policy, giving the government the ability to spend and borrow more at cheaper rates in order to print that money and spend it into the economy. Again, there is no net change on the overall size of the financial system from this, but it is taking liquidity out of one area of the market and injecting it into another broad area through the government. And that shift alone can change the behavior of lenders, borrowers, and investors more than the headline number suggests. So that means continued tightening in mortgage-backed securities, but easing everywhere else. And given the fact that the White House is currently talking about a 50-year mortgage, if that ever becomes real, that would likely offset some of the tightening in U.S. housing that continues from the Fed's mortgage-backed securities runoff. Even though most people don't keep the same mortgage for 50 years, the structure still lowers the payment today and stretches the debt and the total interest bill much further into the future. Okay, so the next few areas of easing you should expect to see on the economy and the markets all have to do with the government shutdown ending. The first one comes from the government's checking account itself. This is the Treasury General Account. And looking at the last couple of months, you can see the government has spent those months rebuilding the balance inside the Treasury General Account. This is where all the money from taxes and borrowing goes in, and all the money they spend goes out. As a result of the government shutting down, they've been spending a lot less than normal, but still taxing and borrowing the same amount, which means their balance has been climbing higher than where they like to keep it, around $850 billion. Right now, it's already up around the mid $900 billion range. So there's a lot of cash just sitting there that normally would have been flowing through the economy. But now that the government shutdown has ended, all that money that hasn't been getting spent will get spent. That's to make up for all the lost spending, the paychecks that didn't go out, and everything else from a shutdown that stretched on for weeks. Now, this process does take time to get everything back up and running, so it's not going to be an instant boost, an instant flood of money into the economy. But over the next couple of weeks and couple of months, we're likely to see an easing effect from all that captured cash getting pushed back into the system. This should also result in a little bullish price action in the stock market because recently we've had hundreds of thousands of people not getting paychecks, meaning they haven't been making their 401k contributions. And maybe they've even been forced to sell some of those assets to pay the bills while they waited to get reimbursed. And government shutdowns don't save taxpayers money. They cost more because we have to pay everyone back for all the paychecks during the shutdown, even though the work didn't happen. All things being equal, assuming nothing else offsets this, this would be a bullish force on the market. All right, the next thing coming out of the current administration in terms of stimulus is a $2,000 stimulus check. Well, not a stimulus check. Don't call it that. It's a tariff rebate. And right now, this is still just being floated and talked about. It is not law and it is not guaranteed, but it is on the table as a serious idea. Now, is it true the United States is collecting a lot more in tariffs than in past years? Absolutely. At this point, between the new and existing tariffs, you're looking at something a little above $200 billion in revenue, with close to $200 billion of that just in the latest fiscal year alone. But $200 to $300 billion in tariffs is still nothing compared to the roughly $7 trillion the U.S. government spends every single year. And not only is it spending around $7 trillion every year, it's running a deficit of roughly $1.8 trillion because it cannot tax the economy enough to pay for all that spending. So there's no real surplus happening from this tariff money. Maybe it ends up being closer to $300 billion in tariffs, and that's assuming the courts don't strike down parts of it. So there is no true tariff rebate surplus to be talked about here. There is no extra income. There is no surplus. There is no balanced budget. Tariffs are a tax. On paper, they're charged to importers, but in practice, most of that cost gets passed through the supply chain until it shows up in the prices that you pay at the store. And if they take that tax money and send it out as $2,000 checks, they're paying for it through more borrowing because they're not taxing enough to fund the spending. And if you know anything about how the dollar works, when money is borrowed, it is lent into existence, which means as the government runs deficits, that is money printing. Now, if this happens, it's not going to be sent to every individual and not even every household. But out of the 340 million Americans, let's say 100 million of these $2,000 checks get sent out. The cost would be roughly $200 billion, wiping out any fiscal gains the tariffs brought in to begin with. And if you remember anything about what happens to markets the last time stimulus checks went out, you know the pattern. It hits asset prices almost immediately. It fuels speculation and bubbles and then drives up the prices of goods and services. So it drives inflation higher, even if it feels good in the short term when that money first hits your account. And that fear of getting a short-term boost that turns into long-term pain is exactly what a lot of people are reacting to right now. All right, the last change coming to the economy and markets soon is the reshaping of the leadership at the Federal Reserve. We know the current administration wants lower rates. We also know that Federal Reserve Chairman Powell's term as chair is scheduled to end mid-2026. So within the next year or so, barring reappointment, he will be replaced. And we see people like Hassett saying he'd accept the chair job and he wants lower rates. We've heard the same sentiment from others. And given that it's the U.S. president who nominates the chair and the Senate who votes, we're likely to see nominees who want lower rates. But it's not just the chair position opening up. We also just got news that Atlanta Fed President Bostic is leaving his position when his term expires at the end of February. That opens up a new spot for someone who wants lower rates. And don't forget the ongoing drama with the Federal Reserve's Lisa Cook and the Supreme Court's upcoming look at whether the president has the authority to fire her. Oral arguments in that case are already scheduled for January 21st, so we know that decision is now on the court's calendar. If that goes through in favor of the president, again, that's another position that could open up for someone who wants lower rates. So across the range of possible outcomes with Fed leadership, we're seeing the leadership being reshaped as people are replaced with others who want these lower rates, just like the White House does. Now, everything that we've talked about so far, the Fed ending QT and starting a soft, stealth QE style move through an Operation Twist type shift, the government shutdown ending, people getting paychecks again, the $2,000 stimulus tariff rebate checks, the 50-year mortgages, the Fed leadership reshaping, all these by themselves are not huge impacts on the market. I think a lot of the volatility that we've seen recently has been due to the government shutdown and the lack of liquidity that came with it. And so the shutdown ending will likely have the most acute effect in the short term. But together, stacked up over the next 6 to 12 months, we're entering a period that is much, much easier, monetarily speaking, than it has been for years now. And given the current level of fear in the market about inflation, crashes, and end of the dollar scenarios, I don't think people are prepared for what a much easier financial environment will actually do to markets and the economy overall. Because if money gets looser, assets don't sit around politely waiting. They reprice fast. And the real question becomes, what does that mean for you if you're trying to step off the hamster wheel and live off your investments instead of your job? And that's why I pulled out this video for you to watch next. It answers the one question people never get a straight answer to: how much you actually need to live off of passive income. Not the fantasy number, the real one. And you'll see exactly how the math works, what kind of returns are realistic in an easier money environment, and how people are using syndications in 2025 to create monthly income without becoming landlords or stock market gamblers.